Hello and welcome to Vox Markets. I'm John Hewman. Thanks for joining us for today's investor webinar with Fintel. The fintech specialist focused on the fund management and financial intermediaries market recently reported a strong set of half-year results, shrugging off wider market worries thanks to its well-diversified business model. We'll shortly be speaking to Joint Chief Executive Matt Timmins and Chief Financial Officer David Thompson and asking them about the strategy behind it and how it's delivering such solid growth. But before we do, we'll be hearing the company's recent presentation to City analysts talking through its latest figures. Thanks once again for joining us, and we hope that you find today's presentation useful.
Good morning, everyone, and welcome to the Fintel half-year results interim presentation. I'm Matt Timmins, Joint CEO of Fintel, and I'm delighted today to be joined by David Thompson, our CFO. So as we get into the presentation, David and I are going to take you through the next sort of 30 minutes or so, looking at the results for the first half of the year. And then we're going to cover off some aspects of important operational delivery, strategic delivery within the business, and then finish by going through our current trading and outlook for the rest of the year. So for those of you who are less familiar with Fintel, we provide key support services and fintech to the major players in retail financial services. We have three customer sets: product providers or product manufacturers, financial intermediaries, and end consumers. And the outcomes that we look to drive across the business is to help product manufacturers to design better products and to distribute those products more effectively through the huge intermediary base that we support. For financial intermediaries, our aim is to help them serve more clients and to provide a compliant, suitable, and effective advice to those clients. And for consumers, quite simply, we're here to help consumers make better informed decisions through our de facto rating system. In terms of the brands within the business, we have two key brands or two leading brands within the business. They are de facto and Simply Biz. De facto operates the UK's largest database of financial products, which it researches, compares, and rates. It provides research and rating services to manufacturers, as well as fintech to product manufacturers and advisors. And de facto has huge brand equity. It has around 75% prompted consumer awareness and 98% awareness within retail financial services. There's great trust in the de facto brand, and advisors are using the de facto software to give advice to clients. And over £42 billion worth of recommendations is going through that software on an annualized basis. Simply Biz is the UK's largest provider of support services to financial intermediaries and is an award-winning business, having won the Professional Advisor Awards for the last 5 consecutive years. We operate with high levels of member satisfaction, with a current NPS score of 47, and high levels of customer retention, with the average tenure being 6 years and 5 months across the membership. So two fantastic brands operating within a key part of retail financial services. And connected together, these two businesses of Simply Biz and de facto create a network effect through the provision of data, workflow, and analysis, which gets richer the more it is used. And it provides an important source of data for product manufacturers and for intermediaries. In terms of the highlights for the first 6 months of this year, we have delivered a solid financial and operational performance. Revenue in the core business is up 9%, with adjusted EBITDA margin coming in at 30% and cash flow conversion at 124%. Our business has continued to prove resilient with a diversified, engaged, and loyal customer base. We provide support to thousands of intermediary businesses and hundreds of product manufacturers, and these intermediaries and manufacturers buy multiple services from us. Our brands are sector leaders with a strong track record of growth and delivery, and the services that we provide are non-discretionary in the fact that intermediaries have to operate a compliant and successful business, and the provision of regulatory support delivered to those intermediaries on an outsourced basis is a really important part of how the market operates. As we move forward and we look towards the next 6 months and beyond, we believe that we're well positioned for growth. We have around 2/3 of our revenue coming in from SaaS and subscriptions, which means we have a really high quality revenue and also very, very predictable. We have significant financial reserves with 7.6 million in cash and also an undrawn £45 million RCF facility. And we believe there are strong growth drivers. Regulation is increasing in its complexity, and with new regulation coming around the corner, we believe that this will increase demand for our services. There is also greater demand from the intermediary market to be able to consume both regulatory support and technology from one organisation rather than buying lots of individual different systems. And as we move forward and we start to blend the technologies together, we believe we have a strong offering for intermediaries and for product manufacturers. In terms of our medium-term targets, we are delighted to report the first half of this year that we are ahead of our revenue target, delivering 9% growth in the core business. We expect that to end up around about 7% by the end of the year. We have moved a significant proportion of our distribution revenue to distribution as a service, meaning that instead of being weighted towards the end of the year, it's actually smoothed out over the year. So a significant proportion of revenue in the distribution segment has been brought forward, meaning that we have a slightly stronger performance in the first half of the year for revenue growth. And we expect, as we end the year, for that to be at the top end of our medium-term objectives, around about 7%. Margin continues to be strong, and incremental margin even stronger. And we hope that that will push us forward towards those medium-term objectives. Earnings quality from SaaS and subscription continues to build nicely, and we're very close there to hitting our medium-term objectives. The business is extremely resilient, and we have delivered or demonstrated a good track record of growth throughout the last few years. Throughout disrupted times and some difficult times, strength of our key brands and the diversification of our services and customers gives us great confidence that we will continue to be a very resilient business that delivers to shareholders. I'll now hand over to David to take you through the finances in more detail, and then I'll come back and summarise at the end. So over to you, David.
Thank you, Matt, and morning, everyone. So overall, in echoing what Matt's just said, we're again really pleased to report a solid set of H1 results that hopefully you'll see show continued demonstration of the robust market position we have, demand for our core services, and that continued growth and strengthening of our balance sheet helps us deliver on our medium-term objectives. So we're doing what we said we would do. So slide 10, if you would. So slides 10 and 11 highlight summary financial performance. We'll get into more detail later on, but on slide 10, we can again see the progress we continue to make period on period, and we've got solid growth across the income statement. So the statutory revenue growth of 2% doesn't actually allow for disposals that we made in the second half of last year. So on a like-for-like basis, the growth is higher, and Matt's already shown that our core revenue growth was 9% period on period, which is at the upper end of the range of our longer-term objectives. And over on slide 11, we can see how that robust continued trading performance underpins the creation of value. So the solid increase in EPS highlights how operating margins flow through to the bottom line with our business model. And again, strong operating profit to operating cash conversion, thanks to working capital inflows in the period, finally show the strength of our primarily SaaS and subscription-based revenue model. So provide those core services to our customers, and clearly be seen coming through in financial strength. And the group, as you can see on the right-hand side, there is now completely delevered and in a net cash overall position. And we've got no debt whatsoever, and that 7.6 million is our gross cash. And that positions us well to fund both organic and strategic growth through acquisitions, as we've always said. That gives us a 50 million plus instant access war chest without coming back to the market for more equity. So in a strong place financially. Over in slide 12, a bit of revenue detail. So that's one of our key slides. It shows progress of key metrics of core revenue growth and the progress in the quality of those revenues that are the SaaS and subscription by nature. So the green section, the bedrock layer, is the SaaS and subs, and you can see 7% growth in absolute terms to 17.8 million, as well as maintaining that 2/3 of core revenue ratio. Overall, core revenue grew 9% to 27.1 million, and the mortgage business continues to drive the commissions-based growth that you see there. The reduction in the grey non-core revenue again relates to that aforementioned sale of Zest Technology in the previous period. And looking at it on a like-for-like basis, the property valuations business was flat at 5.1 million in both this period and the prior period. So again, overall revenue growth is 2% on a statutory basis that we have to show. However, again, I'd like to highlight 9% core revenue growth as one of the key value drivers of the group. Over in slide 13, in terms of profitability. So it's important on this slide that we look at the business by three main operating segments: intermediary, distribution, and fintech and research. And we also split it out by core and non-core revenue, and that helps us provide greater visibility on our areas of strategic focus. So in intermediary, you can see the effect of the disposal of Zest Technology in the prior period is that the segment's now considered all core. So again, delivering on our promises and what we said we would do. And as stated previously, the margins improved now that it's core only, and it's approximately at the 40% level that we'd previously guided to and would expect. In distribution, that core revenue growth of 2%. However, again, on a like-for-like basis, that doesn't take into account the sale of verbatim funds in the prior period, which accounted for 1.2 million of revenue in H1 21. So really, it's an increase from 5 million to 6.3 million. So therefore, on a like-for-like basis, the growth is significantly stronger. And again, that's driven by distribution as a service offering, as Matt said, and the mortgage business, which continues to go from strength to strength. So technically, we can say that those two have all but replaced the revenue forgone by the disposal of verbatim funds. Distribution does house the property valuations business that we do consider non-core, and you can see how that dilutes the margin overall. And for guidance on a core-only basis, we'd expect that distribution to return to a circa 60% margin. And then fintech and research had a really strong performance, 22% growth, driven by software sales to our members. And the margin at 61%, it's in the range, but it's slightly lower initially as we've invested some resource in the short term to ensure that implementation and onboarding of new customers and services is a success. And again, that should be accreting to 65% plus on an ongoing basis. So you can see across all three divisions, the core revenue margins are really strong. In statutory terms, the gross profits increased 7% to 14.7 million, up £1 million. And as you can see, the infrastructure and support costs have increased 11% to £6 million. And that's on the back of investment in our people. The predominant cost base of the business is a people and premises business, and the predominant cost base is our people, and we've looked after them in the current inflationary times. But EBITDA growth of 5% to 8.7 million highlights that the margins still can be maintained due to the diversity and quality of our services and products, and we're on track for our full year forecasts. Over on slide 14, we'll see how that converts into cash. So not only have we got robust growth, but it's also turning into cash very efficiently. So we use operating profit to operating cash flow internally as a measure of how well we judge the business on day-to-day cost control, performance, and working capital control. So that ratio of 124% is driven by inflows in the period. We do tend to have a slight summer peak as we collect some cash in advance in H1 for a certain amount of our products and services, and that smooths out over the year. We also in that slide include EBITDA to operating cash flow and also EBITDA to free cash flow as well, just to ensure we cover other cash flow conversion metrics, and we're not just picking the biggest number, and that's all laid out for you there as calculated from our income statement and balance sheet. Over in slide 15, I think this one really it best demonstrates the effect of the cash generation in a business and the really great strategic positioning it provides us. So we've got cash resources of 7.6 million. They continue to build. and access to an undrawn 45 million revolver. And that just gives us an extremely well positioned place to fund growth, both organically and through acquisition. So the main thrust of the management team is how to invest that capital wisely for shareholder return, firmly believing that we're a growth stock. So on slide 16 in summary, again, used the slide before, but it recaps the key features of the growing business and the strategic performance. So robust performance, growing SaaS and subs revenue increase both the quantum and quality of our revenues and ultimately our cash resources, and our ability to invest that in growing the business further. And again, our progressive dividend policy, again, reiterating we're a growth stock rather than an income stock. We still feel the dividend's an important part of shareholder return, and have declared an interim dividend payment of 1p. Again, stressing the current strength and position of the business for future growth. And with that, I'll hand back to Matt, who'll give us some more detail on how we're performing against our strategic objectives. Thanks, Matt.
Thanks, David. I'll go on and cover some of the operational highlights within the business, and then go on to talk about the outlook and our confidence in the future. So first of all, as we turn to the intermediary services division, this division provides regulatory support services and fintech to around about 3,100 intermediary firms. Firms of all different shapes and sizes, from large national IFA groups to small intermediary firms. Within this division, we've increased profitability by 15%. It's gross profit by 15%, as David's just covered. We've also grown revenues from software licenses by 6.5%, and we've increased our average revenue per customer. In addition to that, we've continued to digitize our core services, and we have launched and delivered new services out to customers, and we have delivered increased customer satisfaction, with the NPS score coming in at 47 for this year. So a good performance across the division, with growing profitability, increases to ARPC, nice development in terms of additional software revenue from software licenses, and doing all that with a very, very happy and engaged customer base. In terms of our distribution division, within this division, we've concentrated primarily on earnings quality. Previously, we had contracts with product providers, asset managers, banks, building societies, and life and pension companies. And those were annual contracts that we went through this kind of contract renewal process each and every year. What we've done within that division is we've moved those annualized repeating contracts through to multi-year monthly subscription contracts. So it really has improved the quality and the visibility of revenue coming in from this division. Importantly, we've scaled that distribution as a service to around 60% now of the total revenue within that. The revenue from those product manufacturers coming as a result of distribution as a service. We've continued to run our events program. That's bounced back nicely after COVID, and we're now delivered 170 events in the first half of this year already on a hybrid basis. So our customers are well used to both physical and virtual events, meaning that if we have anything similar to COVID in the future, with great confidence that we can revert to virtual events, and our customers will be entirely happy and satisfied with the quality of those events. We've grown our share in the mortgage market, so 24.5% increase in applications. Obviously, completions will lag applications by a few months, so this is the data up till the half year. So a good, strong first half performance in terms of mortgages, and we've increased our share within the mortgage market. So overall, a solid performance within distribution, increasing the quality of earnings, as well as making sure that we deliver the right kind of services to our customer base. In terms of our fintech and research division, we've increased revenues by 22% in that division. Importantly for us, that's come as a result of a growth in software license revenue, so 24% growth in software license revenue. And then the other factor that's really important to us is the increase in recommendations that flow through the financial planning system. So that the recommendations through that system has increased by 15%, up to a run rate now of about 42 billion. We entered into a strategic partnership with Tatton Asset Management last year, and we're starting to see firms within Tatton take on board our fintech, and also that's helping to drive the increase in recommendations that you'll see on this slide. So very early days with the relationship with Tatton, but it's working extremely well from both sides, and their firms are adopting our software and driving recommendations through the engine. We've also continued to deliver the de facto 5-star product ratings, which are enjoyed and marketed and demonstrated by hundreds of different product providers. And the growth in revenue on the rating side is up by 12%. So a great performance in terms of the FinTech and Research division, growing overall revenues, and importantly, growing them in the areas that we want to, which is software recommendations and ratings. So as we come on and look at the rest of the year now and how we're doing in terms of current trading, I think the first thing to look at are the key growth drivers that we believe will help accelerate growth in the future. Regulation is starting to increase again. There was a period of time through COVID where there wasn't much new regulation brought in from the FCA, and what we're starting to see that come through now, and particularly in the with consumer duty coming into the sector. So we believe that increasing regulatory pressure will push intermediary firms to outsource more compliance services, and our businesses like SimplyBiz will benefit from that. There is ongoing demand for technology across the customer base. Intermediaries are getting disheartened with buying technology systems from multiple vendors, and we believe that we have a solution for those firms where we can provide pretty much everything they need through one subscription. There is market consolidation, and with market consolidation, it's inevitable that there will also be disaggregation. So both of those drivers are important to us. When the market consolidates, we concentrate on providing fintech and support services to the larger intermediary firms, the nationals and the consolidators. And then inevitably what will happen over time is some of the firms that they have acquired will break away and will start up again. And now we have the SimplyBiz membership services program for those firms who are just starting out and want to go directly authorized. In terms of the economic climate, in times of change and in times of pressure, people look for advice in terms of their finances, and we see growth in terms of the number of people using financial intermediaries to help them make important financial decisions. So we believe the economic climate continues to be strong for the provision of financial advisors. There is more demand out there than there is supply. And we believe this will lead to value creation for Fintel. Our key strategy is to concentrate on digitizing our core platform. This will then help us improve margins and earnings quality, and will make sure that advisors can get everything they need from SimplyBiz and from de facto. We'll continue to convert product manufacturers over to our DaaS product, and also scale the use of that through our protection providers and asset managers. We'll be expanding our proprietary software, investing into new modules and investing into new data and insights within that software, and continue to invest into our hero brands. So both SimplyBiz and de facto, we will continue to invest in those businesses, continue to strengthen their products and their brand. And we believe the combination of these four things will generate value within the business and for shareholders. So in summary, Fintel operates a scalable digital services platform with over 10,000 intermediaries being served through a combination of fintech and services. We have over 3,500 clients using our fintech, and our brands of de facto and SimplyBiz are in an unrivaled market position. We've got great consumer awareness of the de facto brand and huge market share when it comes to SimplyBiz. Our customer base are diversified, they're engaged, and they're loyal. We provide services to hundreds of manufacturers and thousands of intermediaries with strong average tenures, and also the majority of that revenue coming through as a result of SaaS and subscriptions. We have financial agility. We've got 7.6 million of net cash and an undrawn RCF facility of 45 million pounds. This will enable us to invest back into the business, into the de facto software, and will also enable us to go out and make accretive acquisitions of businesses that provide fintech or services to the intermediary market. We have a cash generative business model delivering 124% of underlying operating cash flow conversion. And our business is based on quality recurring income. As I said, 2/3 of the revenue coming through from SaaS and subscriptions. So as we look forward to the next 6 months and beyond, we believe that we are well set up to deliver to our customers. We have the right kind of quality within the business, and we have growing revenues and improving margins. Thank you very much.
Okay, hello everybody. Welcome to the Fintel Q&A. First of all, welcome to Matt and David, respectively, Joint Chief Executive and Chief Financial Officer of Fintel. How you doing?
Very well, thanks, John. How are you?
Not too bad, thank you. So thank you for presenting to us today and for taking the time to answer some questions for us this evening. First of all, I'd like to say congratulations on a great set of numbers delivered in what's been a very difficult year. And it's been a particularly eventful week on the markets this week in a year that we probably thought couldn't have brought any more twists. So perhaps before we talk about Fintel, perhaps you give me your thoughts on what's going on and more specifically how it's affecting your business and how you've actually been able to cope with the market turmoil this year.
Yeah, absolutely. I think we chose quite a difficult week to be out on the road delivering our results presentation. But yeah, I mean, ultimately, we know what's happening out there. Confidence in the UK economy is incredibly low at the moment, and when that's coupled with rising inflation, rising interest rates, and an energy crisis, it makes life very difficult. And I think people are predicting some difficult times ahead in a market downturn. And with that, small cap stocks do get affected, perhaps disproportionately and very often first. I think that you've also then got added to that, investment managers with their funds experiencing redemptions in some cases and therefore struggle for liquidity, meaning that, in many cases, they may well have to come out of some positions that they really want to be in. So I think, yeah, it is a difficult market out there at the moment, and I'm pretty sure it's not going to get any easier for a while. In terms of our own performance, though, I mean, I think you've seen from the analyst presentation that's just been showed to your audience that we've delivered a solid set of results in the first half of the year. Our expectations is that we will continue to grow the business. We're 20 years old now. This isn't the first downturn that we've experienced, not the first difficult market, and the qualities of the business shine through in difficult times. So we're confident, but that has to be paired against a difficult market backdrop, which no one can hide away from.
Absolutely. So one of the things I understand about the business is, that it generates a lot of data. There's a lot of insight that you're feeding back to the manufacturers, to fund groups. And so before we speak more specifically about Fintel, can you talk us through what sort of data you're collecting? How it's fed back, and what sort of things you're seeing in that? What sort of trends are consumers, managers, intermediaries interested in, especially given the market backdrop as it is?
Yeah, okay, absolutely. I mean, so we've got a fintech product which is used by thousands of advisors when they give advice to their clients. And so on an aggregated basis and non-personalized basis, which is really important, we're able to see key market trends that are happening and how buyer behavior is changing. So there's a lot of organizations that can provide data on fund sales and fund redemptions. What we provide is very different, because it's all about the reasons why, the reasons behind the stats, what's happening out there in the market. And look, without giving away too much about a product that we clearly sell, I think a couple of interesting points from the last set of data that we looked at is that ESG funds are pushed out by the market more than they are pulled through by consumers at the moment. So there is a lot of ESG products out there. The consumer demand for ESG is relatively low. So what we are not seeing is ESG figure highly on customers' wants and needs. what we are seeing is a lot of products created with an ESG angle. So there's one piece of information. The other one that we look at and we find really interesting is what's happening to consumers' appetite to risk. So when you look through the global pandemic over those 2 years, what was interesting is attitude to risk didn't change much. We expected people to be in a really risk-off position, but that didn't alter or change throughout the pandemic. What you're starting to see now, however, is a shift towards more low-risk environment and high-risk environment. So consumer preferences changing and tilting towards more lower risk investments rather than higher risk. So it's just a couple of data points there. What we do is we collect data on a whole raft of reasons why people invest into products and funds, the longevity of those investments, the type of products and solutions that they currently already hold, the reasons that they're selling out of those. So that the data is huge, and on an aggregated and non-personalized basis, it really helps these manufacturers to build the products of tomorrow. So if you know what's happening in terms of consumer preference and trend, you can build products or change your existing products to meet that demand. So I think it's really important.
It sounds incredibly powerful, incredibly powerful. And I guess it's going to help you, tap into the large opportunity that's out there. Perhaps you could talk us through it. It's a question in two parts. First part, I think for you, Matt. Second for David. What is the scale of the opportunity, and your competitive position within the market that will help you capture a greater market share? And then one for you, David. How do you scale up? It's something you mentioned in the presentation. How do you scale up to really meet that demand?
Yeah, absolutely. So the scale of the opportunity, I guess, first and foremost, we can provide services to more intermediary firms. There's around 12,000 intermediary IFAs out there, 10,000 mortgage brokers, 4,000 wealth managers. So there's plenty of new clients to go at. We can cross-sell and upsell more services to our existing customers. And we can also reach out and create new services that they don't currently buy from us, that maybe they're buying from another vendor. And then you've got the whole technology angle. So the technology angle, again, allows us to develop new modules of technology to bolt onto the existing platform. So there's plenty of opportunities for growth within the business.
Yeah, and so I guess one for you then, David, is what do you have to do operationally to make that happen?
Sure, and I think that's one of the most exciting parts of the business is how we can strategically grow through both investment of that sort of great cash resource and revolving credit facility we have, and we can summarise that in the 3 Ds, if you like. So the first one is to digitise, and it's principally a people and advice business with support from fintech. So it's to add additional regulatory technology that frees up some of the more basic and administrative tasks that the teams perform, and give that really talented bunch of people the opportunity to add ever more value in terms of compliance, etc. So digitization through taking on more of the putting more AI into the administrative part of the business. That's one way we can scale. The other one is distribution. So again, we've got a really enviable position in the market, but we're always on the lookout to partner, JV, acquire anything we can to increase the reach of these fantastic products that we've got that really sit at the heart of retail financial services, to reach ever more advisors, ever more product providers. I think, again, building on that distribution that we have already. And the third one, which is really exciting, is data and insights. And if you think about the de facto business primarily, rate over 40,000 financial products in the UK, a second to none reach and scale. However, we're very good at curating, collecting, storing, archiving, searching through data. One of the things that we have a real strategic focus on is how we add insight to that, and it's moving away from data analytics to data science. So the third strategic thrust that we're putting our weight behind is how we extract insight and get more value from that data to the market. So we think across all 3 parts of the business, we've got a way to scale the business, very strongly. And if you think about software licensing, again, that comes at a very, very high incremental margin. So we've got opportunity to grow revenue through scale and also margin.
Sticking with data, data and digitization is obviously a very key part of the strategy. Can you talk us through where you are with digitization? What the plan is, with a particular focus on distribution as a service, and perhaps how this is actually changing the industry as a whole. David, perhaps start with you and sort of talk us through the mechanics of the digitization process.
Sure thing. So again, there's an ongoing process of, as is, it's understanding where you are and identifying really what would add value in terms of taking more of the administrative tasks away. You've also got to control risk and make sure that you're delivering on your promises to the huge number of intermediaries to help them run their business effectively and efficiently. So we're talking to a number of partners, a number of market solutions. We're always in dialogue with participants in the market to see what joint ventures, partnerships and acquisitions we might be able to make. And then in terms of distribution as a service, again, that converts the annual marketing style revenue into multi-year contracts. And as a benefit to that, our product providers get much deeper insight into the intermediaries that they're presenting to and can target their sales efforts more efficiently. And what that does, it's a win-win because we get a greater visibility and more regular cash flows in the longer term in nature. So I guess those are the key mechanics of how we would achieve it, John.
I guess one of the things you just mentioned there is the regularity of cash flows, and actually the cash performance this year was absolutely fantastic. That obviously is contributing to the strength of your balance sheet. Perhaps we'll come on to how you potentially deploy that in a minute. But what I'm keen to understand, again, David, one for you, is what are the characteristics of the business that are really helping to drive that really strong cash performance?
Sure. Well, as Matt and I aren't shy of saying, 2/3 of the business is SaaS and subscription based, and that means that you've got visibility. It's recurring by monthly direct debit predominantly, and moreover, certain of the de facto ratings products we sell annually in advance. So the benefit of upfront cash flow and recognise the revenue over that year. So that's why you'll see that our cash conversion each half year is greater than 100%. But typically the business has got a really enviable market position, been going for 20 years plus. So it's not quite a startup that's having to scale. We've got that engine and that machine behind us. So a typical cash conversion on an annual basis will be around the 100% mark. So we've got a very diverse range of over 3,000 IFA firms and 400 product providers. So there's a diversity to the cash flow as well as its regularity. Also tenure, the average intermediary members just under 6.5 years. So again, a very sticky customer base, and that covers 2/3 of our revenue. And also, as to be said, the other third of that revenue stems from our mortgage business and those rating products. So whilst they aren't mechanically SaaS and subscription, they do have a very high recurring nature to them, because we've got customers for a long time. Because once you've got a de facto 5-star rating, you tend to keep it and it's part of your marketing DNA. So again, whilst not quite SaaS and subscription, very, very high quality. So across the board, we've got a number of positive attributes to the business.
Thanks. So perhaps, given you are in a very, very strong cash position, very healthy balance sheet, obviously very, very ambitious growth plans. Perhaps Matt, you can talk us through what the plans are, both organically and perhaps through M&A. Perhaps starting with some of the sort of specifics of how you're expanding research services and the digital side of things.
Okay, last year we did a really important deal with Tatton Asset Management. So they're a great business. We've known them for a long time and we've collaborated well on a number of fronts. And Tatton took the step to help the firms that they support by essentially enterprise licensing our software and making it freely available to every customer of Tatton's. So what that does for us is give us security of revenue. it allows us to sell, a high number of fintech licenses in one deal. And it also means that we have the opportunity to be able to sell additional modules to those firms who take it up. And there are other businesses similar to Tatton where they have a large customer base. And what they would like to know and understand is that that customer base has got a proper, well-recognized system in place so that they can give quality advice to their clients. And so we're having a number of conversations with organizations similar to Tatton. So enterprise deals is one way we can expand the business and one way we're looking to expand it. We're also started providing support services to the wealth management sector, which we hadn't previously done. So we've got a number of firms joined us in a sort of very early stage investment into that side of the market. And then you have essentially regulation driving other opportunities for us. So things like the Consumer Hub drive opportunity for us to go out and visit the firms again and provide additional compliance services at an additional cost. So that's organic. When it comes to M&A, as David said before, we focus on the 3 Ds, which is businesses that will help us digitize, businesses that will provide distribution, so competitors to Simply Biz or De Facto, and businesses that will help us to productize and mature our embryonic data business. So those are the kind of businesses that we're looking to acquire. I must say, it's we're always involved in conversations, and we run an active pipeline. The last 12 months have been relatively difficult because I think asset prices have been too high. In many cases, we've looked at some good businesses, but just felt that they wanted too much for it. And it's too much of a stretch. But we're starting to see those asset prices come down and get a bit more realistic now. So we do see acquisitions as a key part of our strategy.
And obviously, you've spent a lot of time, refocusing the business through disposals as well. Is there more activity to come on that side of things?
So we've done 2 disposals last year, and there is one more disposal, and that's our surveying business. So at some point, when the market is right and we feel it's the right moment, we'll look to find the right owner for that business.
Brilliant. Well, that's all the questions that I have. So thank you very much for answering those. Obviously, you're focused on running the business rather than obsessing over the share price. But I read one analyst recently describe you as a digital business trading an analog valuation, which, from what we've seen today, seems like a very, very fair assessment. So thank you once again, Matt and David, for joining us today, and best of luck as you continue to drive Fintel forward. And thank you all for joining us. If you wish to see a replay of the presentation or view the full results presentation, head over to voxmarkets.co.uk and search for Fintel. Thanks again, and speak soon.
Thanks, John. It's been a pleasure. Thank you.
Thank you.